Welcome everyone to today's webinar titled Fueling the China Boom, Can Australia Deliver? Sponsored by Wilson HTM Investment Group. Hi, my name is Paul Dawber and I'll be your moderator today. While we're waiting for the last people to file in, I'll run through some quick housekeeping. First, to keep the note-taking to a minimum and the interaction to a maximum, we'll be providing you with a link tomorrow to the recording of this live session. And speaking of interaction, please take the opportunity throughout the webinar to write the panelists a question by using the control panel on the right-hand side of the screen. And as always, we'll do our best to answer all the questions you ask, but it may not be possible to respond to each and every one, so apologies up front for that. Okay, so let's get started. Our panelists today are Karen Maley, a senior correspondent for Business Spectator, and Tim Harcourt, chief economist at Austrade. Welcome to you both.
Good afternoon. Good to be here.
Tim is going to start with a brief presentation on the topic, and then we'll open up the floor to questions from the audience for the rest of the session. And also we have 3 copies of Tim's book, The Airport Economist, to give away to the 3 best questions. So ask away, and over to you, Tim.
Well, thanks very much, Paul, Karen, and everyone for joining us today on this webinar. I'm going to go through a few slides. Ben Cousins had his problems, and I'm a bit of a slide junkie, and despite them sending me over to California for rehabilitation, I'm still going to have to show you a few today, but it'll be worth it, particularly if you throw in a good question and get a copy of the book. I've called the talk China and Australia Much Ado About Something, and if we start with the first slide that Danny's very kindly operating for us, we've got to remember that not so long ago things were looking very grim in the world, and in the first slide and in this next slide you can see that trading partner got hammered right across the board for Australia. And the next slide shows you that what we saw with world export values, with world trade growth, that according to the WTO, that was one of the most dramatic collapses that we'd had basically since World War II. Now, despite this all occurring, the next slide shows you that basically Australia performed the great escape. We were the only country, despite the biggest collapse in world trade in recent modern economic history, to actually have positive growth. And when you look at the next slide in the labour market, you see Australia having still a very low unemployment rate, particularly when in the next slide we compare it to other economies in the United States, Japan and the UK, and also generally in the next slide when we show the Euro economies and the US. There was a time when, particularly when I was doing graduate work, that Australia had very high unemployment, and now we've got extraordinarily low unemployment by international standards. Well, why did this occur? Well, the next slide will tell you part of the story. As we know, the decision by Paul Keating, if you've read Paul's memoirs, to float the Australian dollar, or the decision by Bob Hawke, if you read Bob's memoirs, to float the dollar. I haven't heard any reference of it in the Latham diaries, but that decision to float the exchange rate, to open up the Australian economy to international trade and investment, to lower tariffs, introduce superannuation, and to reform our domestic financial markets and labour markets made a big difference. And the next slide in fact shows that as Australia's been an open economy, we've had much higher per capita GDP growth than our other trading partners, including at the time of the global financial crisis. Another reason, of course, is historically the next slide shows you we used to worry about the tyranny of distance, but as we know in the next slide, the power of proximity has become more important. We made that decision, started by the Hawke-Keating government, to open up to the world right at the time when Asia, the region, became more important globally. So that was extremely important timing. In some ways, the lucky country made its own luck. If we'd kept closed right when Asia was becoming more important, we would have been in dire straits. The next slide shows Access Economics' narrative on basically our recent economic history. From 1950 to 1970, Japan drove our export growth, particularly in the resources sector. You can see on the bottom of the axis 1950 to 1970, Japan playing that role as Japan became richer after World War II. From 1970 onwards, Japan still grew and its demand still grew, but at a more decelerating rate. And Axis Economics in the next slide has actually charted the other countries in Asia in the same pattern as Japan, and you can see there China and India playing now a very similar role to what Japan played in the 50s and 60s. Japan sort of opened up the way for the newly industrialising economies, the ASEAN economies, and now China and India right at the spot where Japan was in 1950. So China, the next slide from the Reserve Bank shows how quickly it raced up the charts, took over as our #1 trading partner and export destination in record time, a lot quicker than a lot of market economists expected. Reasons for that, the next slide shows you the stimulus package. When Ben Bernanke talks about green shoots, I like to talk about bamboo shoots because the stimulus package made a great difference. And when you look at trade patterns in China, in the next slide, you can see that V-shaped recovery, and also you see that very large investment that China had in fixed capital. Well, we know well in Australia the story of the eastern seaboard, Shanghai, Beijing, Guangzhou, but the next slide shows you income growth in the second and third tier cities. Cities, when I travel to China, I'm told they're just big country towns, and you find out there's around 8 million people living there, and that's creating demand for architects for construction as they have to build civil buildings, schools, railways, airports, etc. And a lot of that's been done with Australian expertise. On the boomerang, we also talked about India, and indeed India's share of merchandise and services exports has wrapped up very quickly. If China's growth has been like a long test match, India's been like a 2020 game, and that's been quite important in the story. The other reason, of course, during the GFC was, and the next slide shows that at a time when we had such a large decline in world trade growth, our exporters actually had export volume growth. And when we look at sentiment in the DHL export barometer in the next slide, you can see that despite a lot of the recession porn, a lot of the talk of poor economic performance globally, Australia actually held up very well. Exporters knew that things will be tough, but they would bounce back, particularly in the region. And when you look at the labour market, in the next slide, you can see there that rather than fire lots of people in Australia, exporters actually hung on to people because they knew that the rehiring costs in the war for talent would be too strong. So indeed, our labour market performed very well, and Australian employers and workers played a very important role in that. This has meant, as the next slide shows, that trading partner growth has bounced back. China through intra-Asian trade, and the next slide shows East Asia leading the way relative to the North Atlantic. You see a very strong V-shaped recovery there. And indeed, the next slide shows that the emerging economies outside the G7, Latin America, Africa, the Middle East, even Mongolia playing a role in that. Now, I promised a cartoon. Spooner did this great cartoon from The Age showing Australia's story with Asia, with China and India as being a story of the mining boom, and you can see the elephant and dragon there in the kangaroo pouch. Certainly, when you look at mining investment levels, the Reserve Bank's done some very important long-term economic history, and the next slide shows mining investment levels at unprecedented levels, and that has meant in the next slide that our terms of trade, again, are growing at very strong levels that we haven't seen since the Korean War boom. But a good airport economist knows that exports are well diversified. If you see the next slide, you can see even with the very strong commodity price growth that manufacturers' services have also played a very strong role. And the next slide shows you that when you look at sentiment, China's actually very strong. And when you look at the numbers of companies that are in China, there's nearly 5,000 there that export there now, and about 1,500 based there. So China is a resource story, but also when you look at tourism and professional services, education, financial services, construction, Australian exporters have actually done very well on the ground in China. And in fact, in the next slide, you can see the census data shows that if you look just at small and medium-sized enterprises, China's actually now in the top 5, along with ASEAN. So it's not just English-speaking economies where we've got a lot of our action. Now, before I finish, I'll just talk about a couple of risks. Climate change is obviously a big issue, although Australia itself, as Nicholas Stern predicted, has been a very important exporter of environmental services. Secondly, there's an issue taking a walk on the supply side about labour shortages, skill shortages and bottlenecks that we'll turn to in the discussion. And finally, in the final 4 slides, demography. People are not only concerned about the ageing of the population and the financial implications in Europe, in Greece, for example, where German workers that are working in factories when they're 70 are worried about Greek workers retiring at 55 on the Greek islands, but also in our part of the world, demography matters. The first slide shows you Japan. Japan is ageing. They have no or very little immigration. It's running out of husbands. If you look at the shape towards 2050, it's got a very feminine and ageing population, so that will have implications for Japan. China, our subject today in the next slide, by contrast, if Japan is running out of husbands and China's actually running out of wives because of the one-child policy and also their own ageing of the population. In the old phrase, if they're getting old before they get rich, will put pressure on their labour market. By contrast, India's actually got a very young population, hence India's demand for franchise businesses from Australia that's made a big difference. So in conclusion, we've got a few influences that are helping. Certainly the engagement that we've had with China has helped us. The stimulus package in China has helped us, as has our domestic one, but we do have to watch carefully for demographic issues and other non-economic issues that will be important. But basically, I think China will play a leading role in Australia's future. And just to finish off, that's actually my own Chinese connection. My little daughter Yunxi, who is now 6, you can see her there. She couldn't join our webinar today, but she does think the Chinese should still have a fixed exchange rate if you ask her. But we've got a pretty good free trade agreement in our family, so we won't have too many arguments. So I'll leave it there as a way of opening up the discussion, and I look forward, along with Karen and Paul, to have a conversation with everyone.
Thanks for that, Tim. I can see a business opportunity there, getting Chinese men hitched up with Japanese women in the future. Now, everyone out there, remember, please go ahead and ask questions. We're here to answer them, and we have one ready to go from Jim, the editor of Lloyd's List DCN, who asks, will China follow the same or similar economic development path as Japan, Korea in the post-World War economic development period, and over a similar duration, or will China follow its own path and its own time frame? Tim.
Well, thanks very much. And Lloyd's List always quick off the mark, and indeed provide a lot of things to this debate. I think there's a couple of differences. I think I guess demographically, Arthur Krober from Dragonomics says that for the most part, China, because it's very large rural population, had a reserve army of labour for a long period of time, and that will basically change towards 2020, while to some extent Japan and Korea had a high emphasis on capital goods. The changes in China I noticed anecdotally that come out in the data I showed you was when I was an union official with the ACTU, I went to China once and went to a factory, and I asked them if there's any workers' compensation in China, and went through the translator, and the translator came back and said, no, if the workers break anything, they don't have to compensate us. And I think that was said because they could say it, but I think that will probably change over time as you're getting more rural-urban migration. So in response, I think the labour market issues are quite different because of the large population of China, and probably the capital intensity is quite different. Although I think, although China's taken over as our #1 trading partner and so on, if you look at the ownership of trade patterns by Japanese international companies, Japan's still got a very, very strong role to play in intra-Asian regional trade, and including Australia.
Well, welcome, Karen.
Hi.
What do you think about that?
I might just jump in here. I guess, there's undoubtedly China is following a very similar model of economic development to the Japanese model. But I guess one big difference, well, two big differences. First of all, China is potentially a much larger economy, and then I guess the other big difference is the whole backdrop of the Western world has changed so much. So whereas Japan was using a sort of export-driven development model to sell to a West which had a growing, growing wealth and growing consumption, and was able to easily absorb those exports. There perhaps is a constraint with China and China's ability to sort of continue to use the same model and find markets in the West for its goods. So I'd say they're the sort of two big differences.
Yeah. Now, if you've just joined us, we're talking with Business Spectator's Karen Maley and Tim Harcourt, Chief Economist at Austrade. And we do have another question. And Jim asked this one. Mongolia has been touted as a big source of commodities for China. Now, how much of an impact will this have on Australian exports in the future? I'll toss that one out there. Who would like to answer it?
After you, Tim.
You go first, Karen. I can
Look, I think there's a huge priority for China, obviously, is securing, making sure it has sort of security of resource supply. So we've seen, Mongolia are obviously of great interest. We've seen it. China has recently signed a, $6 billion trade deal with Russia to develop coal mines in Siberia. So I think it will definitely focus on developing secure resource suppliers that are very that are geographically close.
Tim?
Yeah, that's an excellent question, because I've just found on my blog an article about Japanese-Chinese leadership with respect to Mongolia. So it's a perfect segue. I think look, I was in Mongolia last year, and I've noticed there are a couple of things. One is they've been very traditionally reliant on Russia for education and even elements of the language rather than China. They're very allied to Russia, and as a result, they've actually got a reasonable stock of human capital in the engineering schools in Ulaanbaatar and around the place, but not the management expertise. And when I was in Mongolia, they, of course, announced the enormous deal they had with Australian and Canadian interests. And what Australia was providing, to some extent, was actually the management and engineering expertise. Leighton's is there, as well as a lot of our major blue chip corporates. And I think that will be important, and that's why Mongolia is sort of one of the places to watch there. And one thing I did learn in Mongolia, apart from the fact that you say Chinggis Khan, not Genghis Khan, locally, because everything's named after Chinggis Khan, from the airport to the vodka to the hotel. And Chinggis Khan actually, I'm told, discovered free trade, because when he had his empire over Asia Minor, he actually lowered tariffs within it. So I thought it was David Ricardo, but it was Chinggis Khan after all that.
Thank you. Now we have another question. It's from Daryl, and it's for you, Tim. I hear about the risk of policy stuff-ups, that is fiscal or monetary policy errors, present to the global and Aussie economy. What's your take on this concept?
Well, I'd say if you looked at the narrative of the opening presentation, the comments since, domestically, we've been pretty good with policy. If you think about the global financial crisis compared to the Great Depression. In the Great Depression in Australia, what did governments do? They cut the budget. They ran very tight monetary policy. They cut wages. The arbitration court in the time cut the basic wage by 10%, and unemployment became much worse. And they put up tariffs everywhere. And in the current economic downturn, what did we do? We had a stimulus. We ran monetary policy that would allow people to have confidence. We ensured that wages grew in line with productivity, and we ensured that tariffs were low and economies were open to foreign direct investment. So I think to some extent governments have learnt in overall policy stances. Fine-tuning's another matter, but Karen would probably have a comment on that too, I'd imagine.
Yes, well, I think there's, in terms of China, I mean, the Chinese government, Beijing is trying to do a very difficult thing at the moment, trying to rein in the property sector, trying to rein in excessive speculation in the housing market without, and engineer a soft landing. And for the economy without actually sort of driving too hard a landing. So I think that's always very difficult for a government to engineer.
Let's go to another question.
Sorry.
No, go ahead, Tim. You first.
Oh, sorry. I was just going to. Interesting that question we had on China and Japan and economic development. I was just reading on the blog about Japanese leadership traditionally, because Japan's an island state. In history, when they were isolated, it had nowhere to run to, so they had to really go forth and do things. In China, it's got a big terrain. Leaders could retreat and hide in Mongolia or whatever they needed to do. And a lot of this commentary was surrounding some of the Japanese leadership in economic development, where they really did have to go forth after industrialisation, while China could tactically take the long-term view. And I think how it relates to Karen's comments on China is that for many years they had a reserve army of labour, so they could basically have no inflation constraint in the labour market, and that's how they were able to do it. Now they've got this test on whether you make an adjustment in the exchange rate or whether you tolerate to some degree domestic inflation. That will change as their labour market becomes tighter. Arthur Kroger from Dragonomics, a very well-renowned think tank in Beijing, basically believes that after 2020, when they get that ageing of the population, they'll be able to play it reasonably well, but after that there'll be significant tightening, which will force them to make that policy choice.
Yes,
Now,
Tim, it's interesting, isn't it, Tim, that you are actually getting signs of wage pressures emerging in the sort of urban labour force, particularly in the multinationals.
Yeah, there's still labour shortages.
Yeah.
Now the question, David read recently that the Chinese government had ordered power cuts and factory shutdowns in an effort to meet a 20% carbon reduction target by the end of the year. He wants to know if that is real and what impact will this have on demand for Australia's products. And Karen, what is your take on that?
Well, everything does suggest that it is real. There is a 5-year plan which ends in 2010. This 5-year plan ends in 2010, and the aim of Beijing was to get a 20% improvement in energy efficiency. Up to last year, they'd managed to get 15.6%, and so they had a bit of a way to go. But of course, then they had the massive stimulus with huge increase in spending on infrastructure and housing, so they fell behind targets. And so there have been sort of blackouts of factories and for housing and even traffic lights in an effort to stem their energy usage and improve their energy efficiency. And it looks as though it's been fairly selective too. They've particularly targeted the small sort of inefficient steel factories. And that looks as though there's been an attempt to get them, they want a more consolidated steel industry so that the smaller steel factories actually, are forced to either close down or amalgamate. And that would it looks as though there's a deliberate attempt there to try and get them to consolidate, and which would actually boost their bargaining power when it comes to negotiating iron ore and coal prices with the big sort of Australian and Brazilian suppliers. Tim?
Okay. We'll move on to a question from Andrew. Australia's exports to China are heavily concentrated in iron ore and coal. Do you see the composition of our exports diversifying either to other resources or higher value manufactured goods or services? Tim, you might know that one.
Yeah, sure. Well, in the answer to the previous question too, I mean, our coal exports have increased tenfold in the last year, and there was some degree of evidence, that China was moving towards importing from Australia for the reasons they mentioned on emissions. Secondly, we've seen a great growth of green technology in Australia, helping a lot of Chinese local companies in the same way, and that's what Nicholas Stern, apart from the attention the Barrier Reef got, he said Australia would be a sophisticated export of environmental technology to China and India if they reduce their emissions. So I think that's part of the story. Well, the commodity story is still the big one. There were two things I've noticed. One, anecdotally and in the data. One is the large proportion of SMEs exporting to China now in the top 5, where traditionally it's always been basically New Zealand, Britain, USA, Singapore. China now part of that story. Secondly, when you look at things like education, tourism, financial services, architecture, inbound tourism domestic tourism within China, we're seeing a lot of growth. So I'd imagine that we will still be fueling China's massive industrial development, but also as China moves from being export-led development to raising domestic savings and investment, I think some of those Australian companies that have a presence in China will benefit, as well as the people that export from here. And I think to some extent the global imbalances that we've seen is America having too many shoppers and not enough shippers, and China having too many shippers and not enough shoppers. So we've got to basically move the US more towards exporting and China more towards domestic consumption and investment, and I suspect that was what was happening even before Lehman Brothers.
Now to Karen, to add to this, a question asked, what is the likely pattern of trade volumes for the export of coal and iron ore to China, and how will the volumes of commodities develop?
Well, I think our likely export pattern is going to follow very closely to China's actual GDP growth. I think when you see really strong growth like we've had in the first 6 months of this year, with the economy growing sort of above 10%, then obviously we get a huge surge in our exports. As the economy sort of comes off the boil, obviously the growth rates will sort of come down a bit too. I think also China's clearly wanting to diversify its energy supplies away from such a heavy dependence on coal, and it's looking to, for example, we've signed that $40 billion plus 20-year supply agreement for LNG from the Gorgon field off Queensland. So, and there's also the potential for future uranium sales. So I think there's a lot of, we'll probably see continued strong exports of iron ore and coal, but also developing exports of other energy sources to China.
Oh, well, you'll both be happy to know that the questions are coming in thick and fast. This is a very interesting subject, and there's plenty of questions out there. This one's from Sandro. The acquisition of energy resources will be important for China's growth. What do you feel the main sources will be?
Stephen, do you want to do this one?
Sorry, again, Paul, the question?
The question is, the acquisition of energy resources will be important for China's growth. What do you feel the main sources will be?
Well, I mean, there's a couple of things that will be happening. One is, I guess, resource security. So we've seen some growth in outward foreign investment, and I think what's occurring too is that if you compare China to India, China had a very strong dependence on foreign direct investment, sort of a Walmart type effect, while India had its large local brands, Tata and Infosys and so on. Now China will build those brands as well, and that will have implications. And secondly, I think even when you look at resource security, foreign investment from China is also diversifying into manufacturing and financial services, and it's not a surprise because even if you look at advanced manufacturing and services growth in exports, they're still growing at the past 5 years in the teens. They're pretty. I think manufacturing's grown at around 13-14%, and services at 16%. So pretty healthy growth rates, and that will affect foreign direct investment.
Will they be involved in like the auto industry and electronics as Japan was in the 70s? This is getting back to an earlier question, I guess, where they said the similarities between the two. But we don't see much in electronics and automobiles at this stage. I mean, they are in there, but are they going to be a power to reckon with in the future? Tim?
Yeah, well, I think that's happening already. I was on the BRAC's Automotive Commission that sat in Victoria on the future of the car industry, and most of the most bullish investment was from China because of the large domestic market. And in fact, apart from the Middle East, when we looked at export potential in the automotive sector, the Middle East, the Mekong Delta, a lot of companies were actually based in Thailand and Vietnam and within China. Because that's where the market is. There's only so many utes we can sell here, but we can sell a lot within China and in the Mekong Delta region.
Now we've got a question for you, Karen.
Yeah.
Oh, sorry. Did you want to comment on that?
Oh, I was about to point out that our next lot of trains in New South Wales are going to be manufactured in China.
Oh.
The new rail carriages for New South Wales, yes.
Well, here's a question for you then on the proposed mineral resources tax. It's from Barbie, and she asks, given China's reliance on Australia's resources and the new Australian government, what is the current status of the MRRT? Are there any expected changes to it, and how would this affect the Sino-Australian relationship? 3 questions there.
Well, I think the MRRT has been sort of substantially cut back from the original super profits tax that was proposed. I think it's very much a domestic matter. It's a matter of dealing with the independence, Gillard's negotiations with the independence, the final shape of the MRRT. But it is actually a tax on, it will probably not affect our exports so much. It will actually, it's much more an issue for revenue and shareholders rather than actual export volumes and prices of exports. Tim, what would you say?
Well, you're the expert on this, Karen, I think. I mean, we've got 20 years of possibly more of a large commodities boom ahead of us, and that will obviously play a very important role between China and Australia.
Yeah, well, keeping with mining, Angela asks, what impact do you expect the impending labour shortages in the mining industry will have on the Australian economy?
Well, this is an issue, this is a very big issue that's weighing on the Reserve Bank's mind because obviously the resources boom is pushing up. We're seeing a huge amount of investment and likely future investment, and it's huge demand for labour, and it's pushing up labour costs in the resources sector. And so the Reserve Bank is just playing a very delicate game, trying to watch the rest of the economy. It has to, because our resource sector is growing so rapidly, the rest of the economy has to grow at sort of at a lower rate to make sure that inflation doesn't break out overall. So it's sometimes called the Dutch curse. What happens to an economy where you get one sector which is enjoying sort of really booming terms of trade? What happens to the rest of the economy as the Australian, as the currency appreciates and all this income flows into one sector? How do you stop? How do you maintain activity in the rest of the economy without sort of having a wages and prices blowout?
Karen,
as well as
go ahead, Tim.
As well as the term Dutch disease in economics, in Australia it's known as the Gregory effect, because Professor Bob Gregory at the ANU, very distinguished economist and former Reserve Bank board member, wrote about it in the 70s in terms of the resources boom in the 70s and the impacts it would have on other sectors of the economy. The difference today, of course, is that we have an economy that's not protected. When Bob Gregory talked about it in the 70s, we had an export-orientated agriculture and mining sector, and we had a very protected manufacturing and to some degree a protected primary industry sector. Now we have an open sector all round, and we also have an export-orientated manufacturing sector and a manufacturing and services sector that provides inputs into the mining sector. And what I've noticed in the export confidence surveys we've done at Austrade with DHL is that there's obviously strong confidence and growth in the mining states, in the Sunbelt states, but there's actually a fair bit of flow through to the so-called southern or Rust Belt states, as they used to be called, because they're providing a lot of input into the mining boom.
That's right, yes.
Karen, some of our listeners are saying that your commentary has been alert to the risks stemming from China, such as the major threats that may stall China's growth. And this great question from Richard is a bit specific. He asks, how do you see the delicate balance of power that exists between the command economy, communism, the presence and role of foreign multinational corporations, and the pressure from the US and EU to float the yuan?
Sorry, do you mind just repeating the
Yeah, it's a good question, isn't it? Yes. How do you see the delicate balance of power that exists between communism and the role of foreign multinational corporations and the pressure from the US and EU to float the yuan?
Well, this is very interesting. It's been happening all year, the dispute between the US and China over what should happen to the Chinese, to the yuan, to the Chinese currency. It's clearly not appreciating nearly as quickly as the Americans had hoped. But of course, from the Chinese perspective, they're terribly worried about letting it appreciate too rapidly, because it would actually undermine the competitiveness of a lot of Chinese manufacturers, and particularly the sort of the low-end, low-margin manufacturers in the textile and footwear industries. So it looks as though the Chinese are finally budging a little bit, but how far now? We've had 3 days in a row where the yuan's appreciated slightly, but how much? This is just a temporary thing ahead of the U.S. midterm congressional elections in November. It's going to be interesting to see whether it does actually appreciate substantially.
Yeah. A question for you, Tim. This is from Jim. How much of the China boom is actually a bubble? Will it pop, and when? If you got your crystal ball there, and what will be the consequences for Australia?
Well, if I knew if it was a bubble or not, probably be at Macquarie Bank, wouldn't I, or doing something else?
That's right.
Look, I think there's a couple of things to take into account, and I think Karen's put it very well. When you had a large reserve army of labour, you could run growth rates at 12% without too much inflation risk. I mean, you had a large, tsunami of labour supply of young women in the rural provinces and so on. Those demographics will change, and that will produce different headwinds. And I think Karen's put it well. I mean, there's a choice between the exchange rate or allowing a degree of domestic inflation, and there's political economy issues around inflation risks within the economy. So they're obviously the things on the minds of policy makers. But there is, to some degree, a lot of macro-prudential controls that the Chinese can use to adjust or to basically absorb booms and bubbles as they need to when they develop their economies. There's a very famous economist, William Boyter, from the chief economist of C Group, and he's written an essay, "Is China blowing bubbles?" In fact, he's not a West Ham supporter, but he's written it about the Chinese economy. So I'd recommend that paper.
Now we have a few more questions, so we'll run for a couple of minutes over time if that's okay. And Yiming has a question for you, Tim. Given China's significant role in the Australian economic development, should Australia embrace more Chinese direct investment and to allow higher Chinese ownership in Australian mineral resources industry?
Yes, well, thanks for the question. Well, I think the answer is yes, we are, and foreign direct investment is welcome. And when you have a look at the growth levels, China, India, some of the ASEAN economies have been very significant investors in Australia now. Traditionally, when you look at our economic history, and I've written a blog on this about the two ages of Macquarie, that is Lachlan Macquarie and Macquarie Bank today, but when you look at our history, traditionally it was the British and Siemens opened up the outback in the 19th century in the US, but more and more it's been Japan and now China, India and ASEAN. So I think that will continue, and Australia has a very open regime.
And Tim, do you think Australia will blow its opportunity through the continuing bottleneck at our major exporting ports?
Well, I think you've already seen pretty significant investments in infrastructure, and you saw the LNG train in the northwest and so on actually helping. David Gruen, now from the Treasury, formerly the Reserve Bank, wrote a very good paper about you see a lot of very strong investment in mining before you see the upsurge in export volumes. And he compared the resources boom of the 70s to now, as did Bob Gregory, and you see quite a significant lag. You have investment in the LNG trains and the ports and so on, and then you see this export boom where we're coming through now. We've actually seen it in the data. So I'd say that the investment we need in ports and roads and LNG and so on is happening, and also in the labour market. I think having important investments in human capital make a big difference. Having said that, I'd rather have a labour shortage and skill issues than mass unemployment, and Australia's managed to avoid it. I'd much rather be 5% unemployment with skill issues than 10% unemployment and real difficulties.
That's right. Well, we better wrap up and let everyone get back to their working day, but we will have one last question, and we'll offer it to both of you. And Angela wants to know, what impact would a significant change in exchange rates have on exports, and when do you think we will move away from using the US dollar as the currency in which export contracts are written in, and how will it impact on our exports? And Karen, if I could ask you to go first, and then Tim, if you could follow up.
What will happen with a rising currency? Theoretically, I mean, textbook economics would say a rising Australian dollar will increase the price, but I think we are China's largest supplier of coal, and we do supply high-quality coal. So, you know, I think the volumes will stay high despite increments in prices. Actually, the yuan is pretty much connected to the US, pretty much still linked to the US dollar anyway. As for negotiation, I think that will happen down the track. I think that we will actually move away from US-denominated contracts, because perhaps when the yuan is you know, more freely traded, then it could be possible that we might end up with sort of yuan-denominated contracts. I mean, China is actually moving towards having doing sort of deals in yuan with other countries, and I'm sure that eventually Australia would be sort of it would be possible with Australian suppliers as well. What would you say, Tim?
Well, look, I'd agree with Karen on that. I mean, I think the obvious demand for Australian energy will continue with the boom, and export volumes growth and world growth is the best determinant of export volume growth into the future rather than exchange rates. And when you look at the exchange rate issue, I mean, your textbook does say about competitiveness, but what it doesn't say is that 45% of exporters are also importers. And there's very significant imported components in our export sector. When we go into a mining boom, we actually import a lot of tractors and a lot of capital goods. So I'd say there's a bit of swings and roundabouts with the exchange rate, and I'd much rather have a high exchange rate and world growth than slow or non-existent world growth and a low exchange rate. I actually think the exchange rate did its job right through the GFC. In terms of adjustment, it's much better that the exchange rate adjusts than our whole economy.
Well, as we wrap up today's webinar, I'd like to mention Wilson HTM Investment Group and thank them for sponsoring today's session. I would also like to thank our panelists, Karen Maley and Tim Harcourt. And lastly, thanks to you for attending and your involvement in today's event. We appreciate it, and there was some fantastic questions, and I hope you learned a lot, and sorry to those that didn't get answered. There was lots of them, I can tell you. Please take the opportunity to provide us with direct feedback about today and send us some topics you might like to see covered in the future. You'll be sent a link to the recording tomorrow. We hope to see you again at another of these informative and interactive sessions. So thank you and goodbye.
See ya.
Thank you. Bye.